we had a couple of days of a lot of economic data pouring through, but of course everybody's looking towards this FOMC meeting next week where it's widely expected to get a rate hike. The question is going to be, when's the next one going to come? Is it June? Is it earlier than June? Most likely not, but is it going to be June or is it going to be September? That's what people are going to be watching for. And the economic data the last couple of days, especially today, has looked really good in an area of of the market, in the sector of the market that's been really beaten up. So that's where we're going to focus today's trade idea, to see if this strength, relative strength in the sector, as well as some strong economic data in that area, can give us an opportunity for some rotation into and some value. So let's go ahead and get started. Today is day 2 of the NCAA tournament. Oh, sorry, no, not days. That's how I mark the calendar. Today is March the 16th. 2018, a Friday. This is the market outlook from marketscholars.com. My name is David Settle. Thank you very much for watching tonight. Welcome to those that are watching us for the first time. I'm glad you found us. Keep coming back for more. Subscribe to our YouTube channel by clicking that red subscribe button. It's right down below this video. You can do that right now while you're watching. Also, while you're down there, click that like button, that thumbs up button. That lets me know that you found some value out of today's video, that you liked it. It also tells me to go ahead and do this video again on Monday. So it's a one-click way to give me feedback and tell me what you're thinking. Also, comment on anything that stood out to you from today's video. You have to scroll down further to the comment section there. If you're watching this on our Market Scholars blog, again, the address for that is www.marketscholars.com/blog. If you see us there, you can comment there as well and subscribe to that site by clicking on subscribe in the top right corner. You can follow me on Twitter for more content in addition to these videos. So make sure you can see my handle up on the screen over here, actually, at DavidSettle42. And then finally, join our Market Outlook community on Facebook. Their address is up there too. There's a link I'm highlighting down below in the description that will take you there. Join us to continue this kind of discussion with other people that are watching this video, just like you are, day in and day out. All right, let's start with the S&P 500, as we always do with the market forecast indicator. You can see the intermediate lines kind of flattening out, and the reason being that this near-term line still is down below 50. You notice we are now, what, 1, 2, 3 days below 50, and we got to that lower reversal zone. Now, nothing's too out of the ordinary, and that's why the intermediate line hasn't rolled down yet, because we are, with this 4-day losing streak and almost 5, small gain today, and a very small range. Really, the range really kind of slowing down as we head into this next rate hike. But you can see we're holding support. We're holding support right around 2750. That was a resistance here. We busted through it with a fake breakout there. Only lasted 1 day, came right back down below 2750 the next day with a big bearish candle. That really busted us down. This happens a lot after those fake breakouts. If we break out and then we don't hold it, then you usually get a lot of selling that kind of follows. And then so that's what we had those 2 days. Now we just pushed right back above. It was a technical thing, so we pushed right back up above it. Got back up above 2750. This time, as of right now, holding it. Unlike the last time where it was just a 1-day phenomenon. So that's why our intermediate line hasn't risen or hasn't turned over yet. Market sentiment still points lower, so path of least resistance is still to the downside. Still potentially more down days than up days, but when the down days are small and the up days are big, like these, this week here, that week of trading, then that's the kind of moves you have. You get a lot of down days that are smaller. You get fewer up days, but they're bigger. That's what happens in a market sentiment, in a falling market sentiment environment where you have a bullish trend, because that's what we have right now. Really, since market sentiment peaked here at the beginning of the month, we've had way more down days than up days, but the up days have been really big. And so we're, after bottoming out here, we've been trending higher and pushing our way up. All right, so that's the S&P 500. So still a bullish posture. Still, short-term sentiment is still weak, but not weak enough to be trend changing. And so, we still have the potential for and bouncing back up, considering where support's holding. You can see the Dow is coiling with some really small ranges, the smallest being today. And near-term lines improved more today with this little 2-day gain than what we saw on the S&P 500. So bounce up on the near-term line, not quite up above 50 yet, and still would be a bullish low point because we're bouncing up off a higher low here. And then of course the other major indexes, the Nasdaq kind of finishing flat, about as flat as you can finish, a little higher, but about as flat as you can finish there. Still well up above the 38% Fibonacci retracement, and trading around this high point that we had, probably around 74, 75 in that area. And you can see short-term sentiment looking very similar, but the difference here is Nasdaq's intermediate line is rolling over, but it's above 80, so it doesn't matter what it's doing when it's above 80. It can go up and down sideways. That's a strong bullish posture when you have intermediate line up there. And then of course the Russell 2000 having the best day today. Short-term sentiment improving, strong bullish posture, not quite up above 50 yet, but still would be a higher near-term low point. That's again not anywhere close to touching the 38% Fibonacci retracement. And remember, the false breakout there was 1550, and we broke through that here on this near-term rally, and obviously holding well up above that. So couldn't quite get up above 1600 and stay. So we came down, but again, normal retracement. So everything during this week that has been, it's been a bearish week, but nothing, not bearish enough to alter this trend. Even with long-term sentiment flat at best or falling on these large cap indexes, you still have, the beginnings of this bullish posture, which is more bullish on the Nasdaq and the Russell. It's got that strong bullish posture there. Not so bullish on the Dow and the S&P 500 especially. And short-term sentiment still not quite recovered from being weaker than what you'd normally expect during a good bullish posture. So so while we're not really like back up the truck bullish, we are still got that bullish bias. And this weakness still fits within that bias as basically a potential for a higher low point. You can see the down week here, but still up above 2750, still up above the 50-day moving average. So no new arrow there. We're still above a rising 50 and 200-day moving average, even if the gap is slowly filling. That's why we're losing momentum. We're just not as bullish as we were at the end of 2017, but we're still got that bullish bias according to that chart. And then of course the 3 green arrows. And again, it doesn't seem like I'm that bullish. And of course, right, there's a lot of volatility right now. The posture isn't that bullish. It's more bullish than the Nasdaq and Russell. But remember, again, here's the pace line for what would be a 23% return for the calendar year, and we're not that far away from it. In fact, the next near-term bounce probably will get us back up to that line, if not eventually up through that. So we're not at a 20% return for the year right now, not anywhere close, but we're not that far off and being on pace for it still. Again, kind of that perspective there. You look at the 3 green arrows, we're still trading around that 8-day moving average. The 8's still above the 17. They're both still above the 30. So we still got everything kind of lined up appropriately for a bullish posture. You just got a falling moving average here, and that's why we're not that bullish. But we are bullish, right? That's we're not bearish either. We still have that bullish bias. Stochastics is below its moving average, so a little bit of a sign of weakness there, and it's rolled over and given a red arrow. MACD has not given a red arrow yet, still up above its rising moving average. So flattening, it's flattened, and the histogram's pulled back because the MACD is pulled to its moving average, but hasn't crossed below it yet. Probably won't unless we break below this 38% Fibonacci retracement, 2750 at the same time, as well as both those 8 and 17-day moving averages. If we break below that and close below that, now things will change. We'll probably be a lot more bearish at that point, or turn bearish at that point. But as of right now, not the case. Remember the concept. You expect support to hold until it doesn't. You've got moving averages, Fibonacci retracement, as well as that 2750 area that has been holding. Multiple areas of support there. Now, of course, nothing's 100%, so it doesn't have to hold, but you expect support to hold until it doesn't. All right, the intraday range, we did get a lower high and a lower low. You see, we traded for the second consecutive day pretty much in the lower half of the previous day's range. So a little bit of, again, weakness in the short term, but not weakness in the long term because, again, as we mentioned before, and now we have to move that up, don't we? The 4-week range here, here's the 4-week low point, and this is what we've been anticipating it to get to because we're not anywhere close to pushing that line down. So we got about a 15-point range, which puts the midpoint of the range right at the 50% Fibonacci retracement of this move, because that is the 4-week range. The 4-week range is the bullish move that we had in the near term. So see how bullish that was? That's the pullback, right? That's our 4-day, 5-day weakness that we've had all week this week. That's what it looks like relative to the 2 weeks before, essentially. So, there's still some support in this, obviously, in this 275, 274 area. We'll see if it ends up holding or not. And again, you expect it will. And, you don't expect a whole lot of weakness yet until at least you get into the lower half of the range. And again, we're not going to push this up anytime soon. Not for another, 1, 2, 3, 4, 5, 1, 2, 3, 4, that fifth, 2 weeks essentially. We're not going to be moving up that low point until 2 weeks. So that gives you 2 weeks to see what it's going to do up here. Before, and if it does get down there, then that's when you start to say, okay. But remember, we don't look for big bearish moves until the range, 4-week range, tightens up. When it's high like this, and especially when you're in the upper half of it, you just expect it to keep pushing up. Not as fast as that's going to move up eventually, but you still keep expecting it to push up here as this moves up and tightens. Then we kind of naturally gravitate towards the lower end of the range. Then you start looking for the breakout to the downside. All right, we take a look. We take a look at the range today, just over 1.25 points. So it's gotten progressively smaller. We did have a small day to start out. Mondays are usually really quiet. But then we had a 4-point range on Tuesday with the engulfing. Then Wednesday, 3 1/3. Then yesterday, just over 2. Today, just over 1. So very small volume. You notice the range. The volume stayed pretty static, and we had the expiration. This is the quarterly expiration. Tends to be pretty active on days like this. So we had relatively a lot of volume this week, but with tightening ranges. So again, that kind of puts you. And then, of course, when you put it in context, 1.25 points is way down here. The volume being slightly below average, it's still within the easily lower half of the 52-week range. So nothing too significantly bearish there. Still got the bullish bias, and of course, you can see volume is still trying to figure out whether or not volatility actually came down from a peak earlier this week at 17.5 or back below 16. So if this continues to push lower below 15, again, remember, I'm not expecting, I wouldn't be surprised actually if we don't get a little increase in volatility, but especially if it were to break 15, we're not most likely, based on how this has behaved in the past. And a reminder for those that maybe didn't see last night's video, when it did get up above 40 last time here in 2015, even here in early 2014, we got up to 24, but you can see when we came down and bottomed out around this 15 area before bouncing up. Came back down again and bottomed out between 1250 and 15. Then we came down, pushed a little bit below 1250. Then we pushed a little bit, further below 1250 and got some spikes up to 15 before pushing down to 10. So we're not going to get to 10. Based on past precedent, you'd expect it to kind of fiddle around here above and below this 15 area before eventually making a late spring run back. You can see it took some weeks here, but before it makes a late spring run back up, which is generally, June, May can be bearish months, possibly back up to 20 on the volatility, which is so crazy because we just never hit 20 at all last calendar year. On a relative basis, you can see volatility still, it's kind of in that neutral area, but it's not above 1. It's not anywhere close to 1. It's not above 95. 90 to 95 is that neutral area. So we're actually a little bit below 95 after coming down. So volatility is slightly bullish. So again, it kind of shows that, yes, things don't look like, like we're just going for it bullish. And yes, there is some short-term weakness. But that's, again, higher highs and higher lows. And right now we're slowly, probably more slowly than normal, we are more slowly than normal, forming, as of right now, a higher low point according to all these technicals. All right, now let's transition into what's driving the price action. And we take a look at the calendar. Again, we've had a couple really busy days of economic data points. Housing starts. You can see that's pulled back from what was a really high level. So kind of 2 out of 3, what would seem to be down months. But also remember, look at that in that level, aside from the election, right? From before the election, this would be the highest level that we had any of those years prior to the election. So, and it's not the lowest one either since the elections. There's a couple down periods during the past calendar year. So it's the down month, but perspective, right? Keep that figure, and it's not a one down month. Of course, doesn't make a trend. You look at the industrial production, and look at that sucker popping back up on a month-to-month basis, but it's more importantly on a year-over-year basis, which now is up 4%, just really taking off here over the past couple of years. There's your industrial production, and then you have the consumer sentiment survey. This is the preliminary one. The final. This is for the University of Michigan consumer sentiment at 102. Again, the highest reading that it's seen. So bouncing back up 45.8 on the economic surprise index. Very strong figure. Again, globally, we're getting closer to 0, but not here in the U.S. U.S. continues to be an outlier from the economic standpoint. And yes, interest rates are falling globally, but in the U.S., the odds of a rate hike are now up to 95% for next week, for March 21st. You can see it was like at 88% or lower than that, 85%, just like a week or so ago. The most important thing next week will not be whether they raise rates or not. That's already, everybody knows, 90% chance. So everybody knows. This is what people are going to be looking at. And you can see it's been dropping, 74%, a little bit of a bounce up from what it was. You can see yesterday here it says 78%. So that's a little bit higher than what we had seen. But you can see that's a pretty, if I take a look at the historical charts on this, and you can see here there's the 2 rate hikes. So this would be, here's your 1 rate hike, and then there's your, so that would be March, right? We take a look at March here, and you can see getting the 1 rate hike, to get to 150, 175 is about baked into the cake. So now we're looking for that 2nd rate hike to get to 175, 200, and it's taken off and getting up there. And a little bit of a pullback, but still very high. So still pretty decent odds. So when you look at, globally, rates have been, 10-year rates have been falling. In the U.S., yeah, we're down this week, but that's the only reason why we're down this week is because we're so high. It's pulled back just a little bit there, and still maintaining a high level, especially relative. So, and again, that's going to attract foreign capital, and as long as foreign capital keeps coming in, that's a positive for the currency. And we talked yesterday about the strength in the U.S. dollar and the impact that can have, and it looks to be, kind of similar to the case that's going on right now. We take a look at today. You can see a second consecutive day of some strength in the dollar. Not as much as yesterday, but still positive. And then you can see here too, big jump up in crude oil. And as I mentioned in a tweet before, when commodity prices really take off, that's when you worry about the mature bull market being done from a long-term basis. And as long as we're not spiking anytime soon in crude oil. You can see now we're bouncing back up and we're closing above the high of low day and whatever you want to say there, getting back up above the moving average. So pushing towards the high, not breaking out of it yet, but pushing towards the high, even with the dollar doing what it's doing. So, because remember, while the dollar has an impact on crude oil, and has a pretty big impact on crude oil, it's not the only impact, and we have to kind of gauge and see what the dollar is going to do at these technical levels here. It hasn't been able to get above this 90, 91, so we'll see how long, this bullish little move can last. But crude oil, crude oil here making a bounce. Pretty positive. I mean, you can see if I draw a line here, let me draw my line. This one coming, whoops. Told you I'm getting used to these charts. You can draw a line across there, you can say, oh, there's a little bit of a breakout there. Not breaking out above the Bollinger Bands, or not breaking above these highs yet, but a little bit of a breakout, a little bit of a start of a breakout on crude oil. And of course, there's a correlation there between crude oil and risk appetite. And look at small cap stocks taking off and result, and long-term bonds dropping today with that risk appetite. And if I just look at the week that was, which was a down week for stocks, it was the worst. That was the worst asset class for the week, was the large cap U.S. stocks. With small cap stocks today, the outperformance today cutting the loss of large cap stocks in half. So they had, that's a positive thing. When you have a decline, a weak decline, and small cap stocks are dropped half of what large cap stocks did, not a bad week. Not a bad week at all. You can see developed markets outpacing emerging. That is what you would expect. You can see during a week pullback too. Long-term bonds had a good week, pulling off of their highs though. With the stocks falling, long-term bonds rallied. And then you can see crude oil, which was down early this week, 2.5% loss, finishing with a gain because of this strong move off of Wednesday's low point, and especially today, getting from a loss of 1% for the week up to a 0.5% gain. The dollar being strong this week puts some pressure in these areas. So while housing starts didn't have a strong big bounce, strong enough that look at the real estate sector having a decent day today. Financials doing well. Energy stocks with the rise in crude oil having a gain. You can see utilities, another one of those embattled areas, doing well. And industrials outpacing the market. Technology, discretionary, state consumer stocks in general, all down. So now that's just today. If I look at the week now and kind of zoom out, look at those two. Those two have been the worst heading into this week. Those two have been by far the worst. In fact, if I were to zoom out here, let's go out to a weekly chart up to. So here's the week that up until now, at least for the 5-year period, and then you can see how they both jumped up. Both these lines jumped up here, and most everything else came down this week. See all the little ticks down on all these? Those weren't down. Those rallied up. So a good week for two areas of the market that have just been struggling with that jump in yields. Yields have taken off, and it's put a lot of pressure. But there are some momentum building. Not a whole lot of momentum. You can see if I look at the weekly chart here, you can see we're still trading below a declining 50-day moving average, which is also below a 200-day moving average. So we still have some. We'd have to get above these highs before you really would even consider some relative strength in utilities. And then you take a look at the real estate sector, the S&P 500. See, we have got that. So that's what you would need to see in the that's what you would need to see in the utility sector before you'd feel pretty decent. And even then, you're above a 50-day moving average. You broke above 31, but it's still not the most bullish. If I take a look at the both these charts on the market forecast. Whoops, right here. So you look at XLU, eventually. You can see its intermediate line is strengthening. It's looking positive, and you can see how that you've got to get above these highs. We've kind of been fiddling around this 50 area, which had been a support, and we busted through it. And we've been fiddling around with it, up and down, up and down, up and down. Kind of need to get above it, probably even get above 51 before you feel really confident. Again, on a relative strength basis for utilities. You look at real estate, and again, it has done that. So it's gone up, it's pulled back to 31. There is its intermediate lines rising too. There's some possibilities, some opportunity there. So one stock in that real estate area that had a good day today, up 1%, and kind of broke out above a recent high with some pretty decent volume is this Duke Realty. Now, the options are not very liquid. You can see it's got some, 3.5 million. Its average volume is at 2.5 million. So there's some liquidity there. It's got a 3% yield, but this isn't something I'm looking at from terms of a long-term basis. This is something and of course the yield story is still high, still going to put pressure in areas like this. But from a relative strength story, where this sector has just been so beaten up, and you can see, we went from 29 there briefly in last September to even more recently, as of last December, we're trading at 28. Dropped all the way to 24.5, so $3.50 drop. That's more than a 10% decline, really, really quickly. But we double bottomed off of 24.5, 26. It's $1.50, so you put $1.50 above 26 at 27.5 for a target to the upside if you're breaking out above that 26 right now. And of course, lots of resistance in that 27.5 to 28.5 area. So if you can get to 28. Then you're looking, and if it takes a month or two, more of a swing trade type of a trade, then if we can get a 10% return out of it, this is one short-term way to take advantage of a change in sentiment towards real estate stocks have been so embattled. You can see pushing up, pushing above these highs, pushing up that upper Bollinger Band. And you can see that starting to expand a little bit. So after pushing down for so long, I'm busting up through and then right back down, hitting the moving average, coming right back down, this time breaking up above the moving average and pushing up. Again, there's opportunity to potentially push up towards this 28 to 29, 28.5. You can see it's higher here because of the dividends that's adjusted on that. But there's opportunity for, again, a short term, maybe a couple of months, but a trend trade that might only last a few months, but towards that 29 area. And again, looking for opportunity within an area stock, within a sector that has been so beaten up and embattled that's showing some relative strength. And it's a stock within the sector that's not one of the biggest outperformers as of today, but it's showing signs of performance, of improvement. So some opportunity for value with the sector as also with the stock within the sector, where both cases are showing improvement, signs of improvement. So in summary, the market is still bullish. Weakness in the short term, more weakness than normal in the short term. We had a pretty decent rally though off of a lower low to some higher highs, and at least especially in the NASDAQ composite. So not surprising that we get a little bit of extended short-term weakness, but not enough short-term weakness to change the posture or expectations for the posture. There has been, during this last few months, there's been some areas, some sectors that have really underperformed, especially these interest rate sensitive areas. There may be some opportunity there, and so. So again, it's a way, today's trade idea, it's just kind of a way, it might not get you a 10% return tomorrow. The options aren't liquid at all for it, but it gives us an opportunity to add something to our active trading portfolio where we can look for some relative strength rotation and take advantage of that. Thank you very much for watching tonight. I'm going to be trying some things out with the blog on marketscholars.com. So if you see some things on Twitter or on the blog or an email, might point you to our blog. You might be watching this off of our blog. So I'm testing some things out, working on some things this weekend. So that's why you might see, again, it's marketscholars.com/blog is where you can find all of our stuff. So that will be starting to push out more and more of. So again, thanks. Have a great weekend, everybody. Good luck to anybody's teams that happen to still be in the dance, the March Madness NCAA tournament. I hope your brackets haven't totally been busted by Arizona losing last night or Purdue losing one of their big guys, their big guy here today. But enjoy the time, enjoy the weather. If you got good spring weather here, we'll see you all on Monday.